You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernal. This year, bond investors will be managing both the lingering impacts of past fiscal policy and ongoing political efforts to narrow the U.S. trade deficit. All the while, Fed officials will be fine-tuning monetary policy to fight the last mile of high inflation while trying to preserve the recovery. Today's episode was a live recording with Matt Klein, creator of the Overshoot newsletter and co-author of the book Trade Wars Are Class Wars, at the City Club of San Francisco. We discussed the pros and cons of U.S. pandemic fiscal policy, what's causing U.S. trade deficits, and how the Fed is approaching monetary policy in the years ahead. Stay tuned. Coming up soon, our interview with Matt Klein, but first, a quick market update. The February employment report this morning showed payrolls grew by 151,000 in February, and the unemployment rate rose from 4.0% to 4.1%. The report came in close enough to expectations that the prevailing narrative will stay intact. The labor market is cooling, but not at any urgent risk of deterioration. Otherwise, the last 2 weeks were characterized by a broad risk-off mood in financial markets, weak PMIs, deteriorating consumer sentiment, and widespread anecdotal evidence of tariff anxieties drove down Treasury yields from faltering expectations for economic growth. The 10-year Treasury yield reached as low as 4.12% this week, and 2-year yields fell below 3.90%. Despite market-implied expectations for stubborn high inflation, Fed funds futures are pricing in close to 75 basis points of Fed easing this year to counteract the slowing economy. Fed officials have still expressed reluctance to change their outlook from the policy path suggested at their January meeting. Most catalysts for growth pessimism are anecdotal or based on surveys that have had questionable connection to the hard data in recent years. FOMC participants have, however, emphasized the upside risk to price levels posed by tariffs. The trade deficit ballooned to its highest on record in January, helping push the Atlanta Fed's GDP Now model to estimate negative 2.4% Q1 GDP growth as of this morning. While imports did surge to front-run expected tariffs, about $20 billion of this came from gold imports that weigh on the trade deficit but are excluded from GDP calculations. Germany's political leaders announced intentions this week to spend up to 500 billion euros to ramp up its military and increase infrastructure investment. Germany is encouraging the EU to relax its sovereign debt limits so other countries can follow in their footsteps. The news prompted the biggest sell-off in German bunds since 1990, based on investors' expectations for higher economic growth and rising supply of safe sovereign debt. Germany's announcement followed a disastrous White House meeting between President Trump and Ukrainian President Volodymyr Zelensky that caused Trump to scale back U.S. military aid for Ukraine. That's all for the market update this time. Now our live discussion with Matt Klein at the City Club of San Francisco. One quick note, we had a couple technical hiccups during the recording, so you'll hear some very brief dead air during the conversation. On to the interview. Welcome, everyone, to the second ever live recording of the Simply Put podcast. I'm Will Compernal. I'm a macro strategist with FHN Financial, and we're recording here at the City Club of San Francisco, and my guest today for the discussion is Matt Klein. Matt writes the newsletter publication on Substack called The Overshoot, and previously he wrote for Barron's, The Financial Times, and The Economist. Matt, thanks for joining us today.
Thank you very much for having me, Will.
So we've got a really interesting conversation set for today. A lot of the expertise, a lot of things that you focus on in your newsletter and that you've written before are things that happen to be quite topical at the moment. So I want to start off with a question about your Substack called The Overshoot. Tell us more about where you got that name.
Sure. So one thing that's interesting is if you take a long-term chart of U.S. real GDP per person, from the beginning of the time series in like 1947, you draw a line, exponential growth, very, very stable trend from 1947 to about 2006. Obviously, there's volatility around that with business cycles, but long term, it goes up, it goes down, it stays on the trend line. 2006-7, there's a series break. The financial crisis just fundamentally changed the growth trajectory of the U.S. economy. And this is not unique to the U.S., but you see this in Europe, you see it in a lot of other countries the size as well, you see it globally. But focusing on the U.S. here. And it wasn't even that the financial crisis downturn was unusually deep, but that the recovery from that downturn was so unusually shallow and slow. And so you take that forward to basically the end of 2019, and you're something on the order of like 15% below the trend, give or take, depending upon exactly how you're looking at it, which is a tremendous shortfall in terms of living standards, in terms of things people could have had, and in terms of hours worked that didn't happen. And I thought of that, that's a massive undershoot. And you can argue about all the reasons why that happened. I think a lot of it had to do with problems in the policy response to the financial crisis. I don't think that was only it, but I think that was a big part of it. And the logic for calling it the overshoot, I started in the summer of 2021 was saying, okay, we have this other big, crisis happening. It's very different in terms of its origins, but nevertheless, there's a significant economic consequences. Let's make sure that to the extent that we can, we don't have this happen again. In fact, maybe we try to do something different, maybe try the opposite direction. Let's see overshoot. Instead of saying maybe we can get back up to a trend line of where we were before, maybe we can say exceeding it and see what we can do and try to push the limits there. And that was the argument for calling it the overshoot. I think, in some ways, we had a success insofar as if you look at the growth trajectory of the U.S. economy relative to pre-pandemic, we've actually exceeded that. Big surprise. Look at whether it's the OECD or the Congressional Budget Office or whatever, what they were saying in like end of 2019, January 2020. We are better off now than people thought we would be pre-pandemic, which I think is amazing given the challenges we've had. Obviously, not everything is perfect. There have been a lot of disruptions. The pandemic itself was obviously very disruptive. But nevertheless, I think in a lot of ways, the policy response, even though now in retrospect there's a lot of controversy about some of the elements of it, I think on the whole, we made the right set of choices, certainly on a risk-adjusted basis. I think we did learn something from that. So I find that very encouraging. I mean, I think there's still room for improvement, obviously. We're still way below the sort of pre-GFC trend, but that's the sort of motivation. That's why we call it the overshoot.
So to help put that into a visual perspective, I know I can't show this to you visually, and for anyone listening on the podcast, you're not going to be looking at a chart, but what you described is sometimes called the frying pan charts, which is that you have this line going up and to the right at a very stable rate, and then there's a dip during the financial crisis, and then you have that same previous trend line, but that is the handle of the pan and then the actual frying pan. I have always been very sympathetic to that argument that we need to get our output, our employment back to that trend line. And like you said, all of that time that we're not at the trend line, unemployment is very scarring for people's professional capabilities, but it also is very bad for their mental and physical health. To the extent that we can improve that recovery, we really improve people's standards of living. You alluded to this, but pandemic fiscal policy in the US took just over a year to recover. It was about 4-5 quarters. And this was compared to 3 years after the financial crisis. So that is about 2 or 3 times quicker. Employment took 2 years and 4 months to get back to the February 2020 level. After the financial crisis, 6 years. I believe it was the end of 2013, beginning of 2014. Now, we also got inflation and deficits. So as sympathetic as I am to how great that fiscal response was and how the recovery was so good, do you look at it differently now in retrospect, considering the hangover that we've had, so to speak, in terms of inflation and deficits? Or do you still feel like our response was on net a good thing, given a pretty difficult situation?
No, that's a great question. I think the thing to remember always throughout this is that the pandemic did happen, and that this was, again, it was tremendously disruptive. So you had people who couldn't go to work who would have wanted to work, people who weren't spending when they would have wanted to spend, people who wanted to buy different things they otherwise would have wanted because the way they normally spend money was not available, right? It's sort of a macro level. It's you're not going to go to the dentist or go out to the movies, but you're going to refurbish your house or buy a new car, and that creates enormous amounts of pressures on what businesses are able to produce, especially when people aren't necessarily able to show up to work safely. That was all very, very disruptive. There was going to be some kind of cost associated with that. The question is, how is that cost going to be distributed? How is it going to manifest itself financially, and how is it going to be distributed? And so what you could have had happen is you say, well, people aren't getting paid because no one's going to the dentist. Well, all the dentists go bankrupt. All the people they employ are going to get laid off. They're all going to get foreclosures on their house. Right? That could have happened. That's a plausible scenario. I don't think that would have been a good outcome. Or you can do sort of opposite. by the sort of real productive sector of the economy, and then maybe if prices go up a lot. I think we ended up somewhere in the middle, to be honest. I mean, you could say we ended up sort of the far extreme, but I think in the grand scheme of things, that's not what happened. I mean, the price level change, cumulatively, I think it's like, what, 20% or so compared to pre-pandemic, give or take? I mean, that's not great, but in terms of the time horizon we had, in terms of the magnitude of the shock, I don't think it was that bad. It certainly wasn't that bad compared to basically most other rich countries, including ones that had very different kind of policy mix. The only places that didn't really have this are very unusual. So China didn't have this outcome. They had basically no social safety net response. Essentially what happened was that you had hundreds of millions of migrant workers in cities who are legally resident in other parts of China in the countryside. They were not getting paid. They're not eligible for unemployment insurance. And tens of millions of them, and we don't exactly, I mean, maybe it's like 50 to 70 million, basically just went home to be subsistence farmers for months in 2020. That is one option, right? They haven't had inflation in a while, but they've had a lot of other issues now, and they're not really happy with that outcome either, right? The other weird kind of case is Switzerland, and I'll be honest, I don't fully understand that. I don't think anyone really understands. I mean, they did some very aggressive currency intervention to make the Swiss franc appreciate during sort of the worst of the inflation, and now kind of doing the opposite. Really, the only places that avoided inflation of any kind of consequence are those two. I don't think it's like there was a unique U.S. problem here. I think this is a challenge of how you're going to. It's a question of how you're going to distribute the pain and the disruption associated with 1 million people dying, all these businesses shutting down, new businesses being created, changes in consumption patterns back and forth quite rapidly, and that's kind of where you ended up.
Something that you actually pointed out in the Overshoot is that 2024 was the first year since 1905 where every democracy that had an election, the incumbent party lost vote share. And you pointed out earlier that the U.S. pandemic fiscal response was quite generous, and not every country had that. So in those 2024 elections, we had countries that had pandemic fiscal response, countries with very different approaches to pandemic lockdowns, parties on the left wing, parties on the right wing. The common denominator is people really don't like inflation, or they don't like the cumulative price changes that happened in the last 5 years. So even if we can sit up here and say, well, the recovery in the US was great considering all of the counterexamples, do you think that the political appetite for overshooting is just not going to be there at the next recession? And politicians might actually overcompensate and prefer a sluggish recovery because they're so worried about enraging voters again with inflationary pressures.
So this is very speculative. I think that actually is a big risk, and I wrote about this. I mean, I think the first thing I wrote after Trump won re-election is, counterintuitively, that the outlook for interest rates longer term might be lower for this reason exactly, which is if there had been a bias of saying, let's see how much we can push the envelope in making recoveries faster. If the takeaway is there's no political benefit to doing that, which I'm not sure is the right takeaway, but if that's the takeaway, then you're going to be in a world where potentially more downturns, deeper downturns, shallow recoveries, that has all sorts of interesting implications. I don't know if that's right. Also, I should know, by the way, I think it's correct, that 2024 election thing, that's from the Financial Times. That's me quoting them. I think they're right, but they did the data work on that. But yeah, I think that the counterpoint is, it's not as if incumbents generally do well when you have the alternative scenario, right? I mean, you look at 1932, you look at 2010, you look at a little more obscure, the election of 1874 in the United States. You have a situation where economic crises, deflationary depression type situations, those also are really bad for incumbents. So it might very well be the case that politicians take the view that the lesson is, try to be seen as being tough on inflation, don't push the envelope here. That might not be the right lesson longer term, even if that's the one they take away from it. Just one thing I just want to add, comparing to the 1930s, if you look at how much GDP grew in the US between 1929 and 1939, it was actually more than what you would have got from 2007 peak to the equivalent amount of time forward, which I think is kind of nuts.
Right, the Great Depression was actually a quicker recovery.
Yeah, and like the ending level in that period, so it was much deeper obviously in the very beginning, but you look at where GDP was, the level of it at the end, and then of course World War II starting goes way higher. So that, I mean, in talking about how the global financial crisis, I think we cannot, I think, underestimate the severity of it, and I think dismissing it as though it's a great recession, no, actually, in many ways this was a significant policy failure that I don't think we've fully really internalized how big a deal it was.
Just about 5 years ago, you co-wrote a book with Michael Pettis called Trade Wars Are Class Wars, and it is proving to be quite prescient these days because trade policy is becoming more relevant than ever. Now, I think the book has a lot of interesting takeaways. The way that I would kind of summarize it before we go into questions about the main themes is that domestic imbalances of wealth and income, specifically in three countries that you focus on, the US, Germany, and China, can lead to international trade imbalances. And so that's where the title Trade Wars or Class Wars comes from. But I want to start with, to get at some of the themes of the book with some bigger picture questions. And the first is, are trade deficits inherently bad? We think about the trade deficit with China, which I believe was over $200 billion last year. And what that means is we are importing $200 billion more of stuff than we are exporting. And because of the way the balance of payments work, we are financing that with $200 billion of capital flows. Now, we are getting more stuff and more money to pay for it. It sounds like a pretty good deal. Should we aim for a world where trade balances are essentially zero? What is bad about a trade deficit?
Yeah, nothing inherently is bad about trade deficits. I mean, the point is, well, first of all, I would just point out that you're talking about a bilateral trade deficit. In theory, you could also finance that deficit by having surpluses with other countries. So that's not even the case necessarily. I mean, it is the case in the U.S. that in general, relative to the rest of the world, the trade deficit is like 1 trillion-ish, 1.1 trillion, and that, in other words, how much money we bring in from sales of exports versus how much money we're spending on imports, that's the difference. And that difference has to be covered somehow, right? Just like as any individual, if you spend more than you take in, you can run down your bank account, you can borrow, you can do something, right? But that there's a corollary there. And at the country level, it's basically the same. Or any kind of unit you use, whether it's a country or a business, what have you. It's not necessarily bad, right? I mean, if you are borrowing money as an individual to make or as a company to make a worthwhile investment in your future productivity or income, I mean, that's fine, right? That's not bad, especially if people are willing to give you the money in attractive terms. The question is that what's happening or not? And so you have to look at kind of what are the drivers of, well, your domestic, consumption investment, your income, what is going on in all of your various trade partners, and how that adds up. So there are plenty of cases where having trade deficits is mutually beneficial to everyone. So one example we have in the book, Martin Sandbu, who is Norwegian, which I'd not heard this example before, but Norway, right, they discover oil offshore in the late 1960s. At this point, Norway is actually a very poor country. Basically, they're salmon farmers, and that's about it. They discover oil. They don't have the resources developed themselves. So it requires a tremendous amount of outside resources, capital, expertise, other things to develop those oil fields, to build everything, to get the workers and all that, right? They have huge trade and current account deficits in this period. But then the oil starts flowing, and now you have the Norwegian Sovereign Wealth Fund. It's like trillion plus, right? I mean, they have like more money than they know what to do with it. It's one of the most expensive countries in the world because wages are so high. So that worked out pretty well for them, right? I mean, that's an example. South Korea is another great example. We think of South Korea as being one of these like export-led growth stories, and it is export-led growth in terms of companies creating products for richer customers outside when they were a poor country. But it's also true that South Korea ran trade deficits basically from independence up until the Asian financial crisis. And that makes sense because if you're a poor country that doesn't really have enough food and energy for yourself, you could squeeze your own consumers to an extreme degree in order to pay for machinery imports and those things. But a more sort of humane and better approach we can get away with it is you get financing from abroad to cover the difference, and you import more than you export. And they did that, and they went from a very poor, war-torn, devastated country in the 50s to a pretty well-off country by the 90s. And then you have the Asian financial crisis, and then you see a difference. And the difference isn't that South Koreans suddenly became much more productive than they were. It's that you have this dramatic sudden stop in external finance, and there's a severe crisis, and the IMF comes in and says you have to do all these things. And so they basically either both through their own choices and what's imposed through external financial conditions embrace austerity. And then ever since then, exports basically keep growing at the same rate and imports grow much less. And so then suddenly they have these persistent large trade surpluses. And you can say, well, that's not good, right? Maybe there is a world in which having trade surpluses would be good for South Korea. I mean, I'm not saying that's inherently wrong, but if you look at what actually happened and the timing of it, you can say like this was clearly a negative sum outcome certainly for people in Korea and also for the rest of the world, because Koreans are buying fewer things. That means fewer opportunities for people in the rest of the world to produce things and sell them and earn a living. And so, the whole point of the book really is you want to look at kind of these specific cases and say, is it a case of for example, is a trade deficit in one country because there's some real productivity boom, they're taking advantage of an investment opportunity, and they're trying to avoid squeezing the domestic consumers to pay for necessary imports? Or is it the case of, well, in one place people are actually trying to kind of have a balance, sort of full employment macroeconomy, but in other large markets you don't have this happening, and so it creates this tension between, well, if we're going to be spending enough to have full employment, but no one else is buying enough, our exports are going to suffer relative to our sort of normal import demand, and then we make up the difference with a lot of unsustainable debt, which is what happened not just in the US in the 2000s, but a lot of other countries in Europe and elsewhere. And so that's really the key thing to distinguish, and that's what we talk about in the book, is saying let's understand what these dynamics are, let's think about what's working well for most people and what's not. And a big point is that it's very easy to look at this country by country because that's the data are published by countries. They're not published by across country in a very easy way to look at it. But it's not really helpful for thinking about it that way because if, for example, the reason why China runs large persistent surpluses is because of all these various features of the Chinese economy that consumers and workers are relatively underpaid and unable to buy what they should be able to afford, that's not good for those people in China. It also turns out that because of the connections we have with the global trade and financial system, that creates all these negative downstream consequences for people in the US and the rest of the world. So it's not really like the US versus China, China's a surplus, China's winning, the US is a deficit, the US is losing. It's really that a lot of people in China are being harmed by a set of policies in China undertaken mostly for domestic purposes. And that's also creating harms for people in the US through the mechanism of trade and finance. And some people in the US and China are both benefiting from this arrangement. So thinking about it country by country is not really the right way of looking at it. And that's really the point of the book, is kind of providing this framework. And that's why I'm saying trade wars are class wars as opposed to thinking about it as a sort of nationalist perspective.
Now, going back to that idea of balance of payments, I think it's important to look at, well, what is the cause and what's the symptom? Because we are not buying more than we can produce. The trade deficit is coming from the fact that we have a surplus of financial flows, which is that money is coming from around the globe into the US because we are so productive, because of, let's say, high productivity tech firms. And I think you did write a post last night about this, responding to Paul Krugman, who had responded to some of your ideas. But there is a possibility that the rest of the world has such sluggish growth and they don't have investable opportunities. So maybe that's why the money is coming into the US, and the counterpart to that is a trade deficit.
I mean, that could make sense, except we have data on what it is foreigners are actually buying in the US, and it's mostly on net. It is not the case that foreigners are buying, venture companies or Mag 7 or anything like that. Like on net, overwhelmingly, it's treasury bonds, agency MBS, and like bank deposits. And so if the argument, now you could say that the yields on those things relative to the yields of the equivalent things in other markets that are, equivalent legal safety, et cetera, are higher, and maybe that's because of our activity. Okay, fine, maybe. But it's not the same thing as saying that we're attracting all this financing from the rest of the world because people want to get in on the US growth story. It's a very circuitous way of getting there. Like if you think the US growth story is great, you're not saying like, okay, well the yield on a American treasury bill is this much higher than the yield on an Australian treasury bill, and that's why you're going to buy that. I don't think that's really the motivating factor. And so, in fact, if you look at just cumulatively, since we have the detailed data, which only sadly starts in 1999, but from 1999 until now, cumulative U.S. current account deficit, which includes trade but also like income flows and stuff, is about 14 trillion. And then cumulative net inflows, just as I said, of debt securities and currency and deposits is like 12.5 trillion. So that to me does not imply that the growth differential is the main driver of this phenomenon.
Another example people give for this situation that the U.S. finds itself in is the so-called exorbitant privilege, a term first coined by one of de Gaulle's finance ministers, I believe. I forget his name. But the idea here is that because of the dollar's stability and liquidity in the global financial system, investors are willing to accept a lower return for dollar-denominated assets than an equivalent return in a different currency. Do you think this plays into what we've been talking about?
I think it's related. Yeah. So it's Valéry Giscard d'Estaing, I believe, who made that point in the 60s, and that was partly because of Bretton Woods rules. As World War II was ending, the creation of the post-war system, the idea was that we're going to have a global system of fixed exchange rates, not tied to gold directly, but tied to the dollar, which would be tied to gold. And the idea is that if there would be any sort of imbalance, you could get dollars, but only central banks convert the dollars into claims on gold. And the French thought this was unfair, basically, because we could create things more easily without having to worry about gold, whereas other countries couldn't. And then they just started converting to gold, and then Nixon closed the gold windows. They couldn't do that, and that's sort of the story there. The question is, why would that persist 50 plus years later? Right? That system hasn't existed for a very long time, and so I think the argument is more likely that, well, the US, not unique to the US, I think this is true for all the sort of English-speaking democracies, but if you are a rich country with strong investor protections legally and you have a language that's very accessible to anyone educated in the rest of the world, you're going to attract disproportionate amounts of financial inflows for safety's sake. And I think that is right. And my co-author, Michael Pettis, I believe he's the one who coined the phrase exorbitant burden, which is if there are only a few places in the world, predominantly the US just because it's the biggest, but it also includes Canada, the UK, Australia, New Zealand, that have this feature, then these economies, particularly the US, are large relative to the world, but not nearly as large relative to global demand for these kinds of assets. And so what ends up happening is that the financial systems in these countries end up being disproportionately affected by preferences of people in the rest of the world, which can have weird consequences for the people who live in these countries. And so, the sort of classic, most obvious case being in the 2000s, right? You have a situation where global demand for fixed income was high for a variety of reasons. There was only so much that was genuinely safe that was being produced, and so you have the private label MBS market appear. And we know how that worked out. And there was like a reason why that happened as sort of a solution to a problem, but it was not a good solution to the problem. And that was very harmful for Americans. And it wasn't unique. That wasn't unique for us either. Like you can see other places having similar situations. Spain is different in a lot of ways, but within the context of the Euro area, it's kind of similar. It was a similar dynamic of you have this big demand for things that seemed relatively safe, getting a little bit of yield. You have we talk about this a lot more in the book if you want the details, but in Germany, you have the situation of a lot of essentially money to go somewhere. It seemed attractive, various ways to get into things like Greek government bonds or Spanish mortgages, things like that. And at a certain point, it might have been valuable, right? But past a certain point, it was just destructive. And so that's really the challenge you have here. And the privilege part, which I think is right, and I think this is something that the Biden administration tried to take advantage of, is if people are going to be buying your assets anyway, then you should sell to them, and you should make sure the stuff you're selling is doing something useful. So if there's this bid for dollar fixed income, don't let it be private label MBS. You should have it on the Treasury's balance sheet, and maybe try to do something constructive with it if you think there are sort of national priorities you want to get in on. And that's like a way of sort of squaring the circle of the burden and the privilege. You still have debt going up, but at least it's a safer form of debt, relatively speaking, and if you do it right, you get something out of it. That is the challenge. If people just want to buy this stuff regardless, that's going to have a consequence, and you have to manage that somehow.
So because of the dollar's unique role in the global financial system, we have very strong demand for dollar-denominated assets in treasuries, and this puts U.S. producers sometimes at a disadvantage, even if our consumers really benefit. And that's what leads to this idea that trade wars are class wars. And so they're all connected. Because U.S. producers are hurt, we are blaming, or so to speak, we're kind of looking at the symptom of these trade wars. So can you talk about how this exorbitant privilege or burden, what is at the heart of maybe the hollowing out of the Rust Belt, or a lot of the change of manufacturing in the U.S. that we've seen in the last few decades?
Yeah, so it's worth backing up and looking at how it is people in the rest of the world would accumulate these assets in the first place. So if you're a foreign reserve manager, for example, what you're trying to do is you're trying to protect yourself against the kind of thing that happened to, for example, Korea in 1997, 1998. And the irony is we have institutions that are supposed to protect countries from things like that. That's the IMF's job, is literally why it was created, is to prevent this sort of thing. And the fact is that it didn't do what it was arguably supposed to do. They wouldn't say that. They said they followed their rules. But at a sort of conceptual level, the point of the IMF is if countries are borrowing a bunch for whatever reason, suddenly they can't, you want to prevent that from being this really painful crisis. And the IMF has repeatedly failed to do that. And so, the 80s debt crisis was like the first wave of this, and then you see it sort of in subsequent events. And so if you're observing this and you're a policymaker, you say, okay, well, if I can't rely on them, then I need to rely on myself. And so you do self-insurance. But just as like in the real world, like it's much more expensive to do self-insurance than it is to have like a public insurance policy. And so if everyone is doing that, what that means is they are foregoing current consumption and current and investment today in order to build up this stockpile of claims that they hope they can use for preventing a future financial crisis. So it's all this foregone increase in living standards they could have had, which, by the way, would have created a lot more demand. This is a very negative sum. Like there is a world in which there's a better way of managing this problem. But instead, people say, I'm going to make myself worse off, which, by the way, because of the way everyone's connected with trade and finance, make other people worse off too, with the goal of making myself better off in some future state if something bad happens. And so even if it works, it still makes everyone worse off compared to some hypothetical alternative where you can manage this risk differently. And so That's I think really the problem here. And again, it's not, the dollar is unique insofar as the U.S. is large, but I really do think this actually applies just as well to like the UK and Australia and Canada and so forth. And that manifests in a variety of ways. So one of the ways it manifests is these currencies are more expensive than they always would be, which means that if you're an exporter competing against countries in other places, you're going to have a harder time. It also means if you're competing in your home market, you're going to have a harder time because imports are going to be relatively cheaper. So it hurts both ways. It also just means, but again, just zooming out, regards to the exchange rate effect, if there's less demand in the rest of the world because people are trying to save more, that's less opportunity to sell. And so that creates, again, it's harder, there's a smaller pie to be divided among all the producers, and that makes it worse for everyone.
You might have heard that the current administration likes tariffs. Would you say that tariffs are a good way to correct these imbalances? To me, looking from the outside, the trade deficits are a symptom of a larger problem, and enacting tariffs could make it worse, and certainly doesn't get at the root cause. And I think the way that it would make it worse is, well, tariffs actually make the dollar stronger, and so it increases, in some sense, those forces from the exorbitant privilege or burden, depending on your point of view, and that it is just a way to, maybe prove that politically something is being done, but is going to make the problem worse.
Yes, I agree with that. I mean, the sort of classic argument for why tariffs hurt exports is not about foreign retaliation. The classic argument is that because it increases the relative attractiveness of investing in the home market to produce for the home market as opposed to abroad, that it makes your currency go up. And if your currency goes up, then your exports are going to take a hit. And so the imports would stay the same, the exports go down, which is also why imports go down and exports go down. So, this is the sort of the traditional argument. I don't know if it plays out in practice this way 100% of the time, but that's the theory. It seems like it is largely right. We saw the tariffs in 2018, 2019 were not huge, but what was the net effect, right? There wasn't really much of an effect on inflation. There wasn't an effect on the trade balance. Manufacturing kind of had a small downturn. That was kind of the net, and customs revenues went up. So the other thing is, to the extent that people do not substitute, so the goal, I mean, there's a lot of goals depending on who you ask or like what time of day it is, but if the goal is you want to increase the relative price of foreign-made goods and increase the attractiveness of buying U.S.-made goods, then if people just keep buying the foreign-made goods anyway for whatever reason, then it's just a tax increase. And so if it's a tax increase, that has another impact, right? Like that's basically just a fiscal consolidation, right? That's just one way of looking at it, and then that just again reduces demand. Like if the underlying problem is that there isn't enough global demand and that the distribution of demand is not really optimal for making everyone better or most people better off, then this is not really helping. If the problem in particular is you think there are policies in other countries that are harmful to people both in those countries and your country, it's reasonable to say you want to shield the citizens of your country from those policy errors elsewhere, but do tariffs do that effectively? I don't think that's empirically what we've seen. I think that there are other things that you can try to do that would help, but it doesn't seem like tariffs are the way to go. I mean, there might be certain specific industries where, as a complement to other things, you might want to see tariffs being used, potentially, but I don't think there might be reasons for national security you might want to do it, but in terms of this economic argument of improving American manufacturing and American living standards, it's not obvious to me how that plays out and how it works.
I think it was 2011, I read a book by Barry Eichengreen called The Exorbitant Privilege that talked about the possibility of coming into better harmony in the global trade system by having not just this unipolar world where only the dollar is that big currency. Now, ever since then, we've seen potential substitutes or competitors, I think, get even weaker as a dollar substitute. So the euro, we had the euro crisis. I always feel like the eurozone is, maybe 1 or 2 elections away from just totally breaking up. It's certainly weaker than it was 10 years ago. With the Brexit, the pound is a lot less attractive, and the Chinese currency also, people have proven to not be as interested in it. You're still talking about as big of an economy as they have. It has its own issues. So how do you think we can get rid of those bad effects of the exorbitant privilege or burden if the dollar is really set to have its role in the global financial system that it has?
First of all, I appreciate you mentioning euro, because usually people ask this question, they just talk about China, and it's like there was a long period of time people thought that the euro was going to be the natural challenger in creating a multipolar currency, and the fact that that's just completely disappeared from the conversation is telling, because I still think they are the likeliest. If there were to be more than one currency financial zone of comparable size to the US, it should be euro area, and yet it's not, and no one seems to think that it will be anytime soon, and I think that is very suggestive. I think there are things that could be done. And again, I think it's basically, if you recognize that this money is coming in anyway, it's just how do you, as a policymaker, think about ways to sort of channel it to your benefit. So one thing is, if you are more open-minded about saying, the federal government's balance sheet is going to take this on, and you can either say so one thing you could explicitly do is say, okay, if you were going to send us this money regardless, and it's potentially going to harm our manufacturing sector, then one thing you would do is you just say, we will put the debt on the federal balance sheet and we will use it to support American manufacturing. I mean, that's not necessarily like the only thing you could do, but it would be an example of something that would make sense. You could also say, I think quite reasonably, look, in sort of some hypothetical world, you'd want money to be taking risk, and if there are countries that maybe for various reasons aren't able to access finances easily, but there are theoretically good investment opportunities, you want to be channeling, like they're not getting that investment. So for example, solar farms in North Africa, right? It seems like that's the kind of thing that should happen. Europe needs the energy, it's very close by, there's a lot of sunlight. There are obviously reasons why there's some political instability reasons why it hasn't happened, but still there are places where you can make that work that are countries that are not as unstable, but it doesn't happen, right? And so you could say, well, the US could do that. I mean, again, like if people are just sending this money in, I mean, again, contingent on the fact this money is just continuing to come in regardless, sort of indiscriminately, you could just send it back out. And of course that creates a lot of challenge about how you do that in a way that's governed well and efficient, and there's questions about how much you want to focus on a return for taxpayers versus what's good holistically. So right, you could say like maybe the money that comes in isn't necessarily invested perfectly, but at the same time, if you send it out enough that it creates prevents dollar overvaluation and helps support the dynamism of American manufacturing, that's sort of on a broad net basis, that it looks more attractive than it would be on sort of a pure return. I mean, this is one of the things I wrote about a couple of years ago, which is you have to be willing there has to be a certain willingness to lose money on these things. Like part of the reason I think the IMF has not been successful at doing the kinds of things it really is supposed to be doing, when you think about the spirit of when it was created in 44, was this very, very sincere aversion to losing any money. Where, I mean, you argue this is true for a lot of the development lending projects, is like, the assumption is that you can get all the money back, and maybe in some of these cases you can't, or you shouldn't expect that. And so, there's a challenge, there's a question, I mean, that you can even extend it further, like the Fed swap lines. They, I think, have become much more comfortable in providing that kind of financial support, and I think the more they do that, the less likely there is a need for precautionary savings by certain countries. But the problem is the countries that are some of the biggest precautionary savers don't have access to the Fed swap lines. And so, it's not necessarily very appealing to them. I think one interesting example, kind of illustrating the challenge here, is there's these stories you can read about, years later with FOIA or whatever came out, that in 2008, Turkey really wanted to get access to the dollar swap lines in 2008. We didn't find out about this like 2014 in public domain, but that was the thing. And the Fed said, absolutely not, because they thought they were going to lose money. Which, from the perspective of their mission is to not lose money, that probably made sense, I don't know. But if we think about it in what is the kind of country that, on the one hand, at that point, like pretty reliable geopolitical ally, and actually an emerging market country that generally was running trade deficits to invest in its own growth, as opposed to doing what a lot of other ones were doing of suppressing demand of exports. Like, that's the kind of society you'd want to reward and not penalize them for that. And they didn't. And then now we look at, you see a lot of places, I mean, not Turkey actually for other reasons, but like a lot of places are even more conservative about trying to self-insure. And you saw this with COVID and so forth. And so, again, like the trade-off is you have to be willing to lose money, but maybe longer term it's better off for, the taxpayer at some holistic level. But that's a challenging question. I don't know how people would add it up or how you have that conversation, because you can imagine very easily how someone who doesn't like it later on would be like, you idiot, why would you, look at all this taxpayer money you've lost on this boondoggle somewhere lending to these foreigners. And so it's a challenge, because I think like that probably is the best approach, but it is not risk-free, and that's the thing, right? It's basically people want risk-free things. That's why they buy the U.S. assets, but the risk goes somewhere. Like either it creates the risk in buying bad U.S. assets, or we recycle that risk somewhere else. But I mean that's sort of you can't make risk go away. You can redistribute it and try to package it in different ways, but it doesn't disappear.
Switching gears big time to current U.S. monetary policy. So you interviewed Chicago Fed President Austin Goolsbee for the Overshoot, and when you were talking about R-star, the idea of the neutral interest rate where Fed policy is neither accommodative nor restrictive, he said that you can come to measures of R-star through three ways: history, models, or just feeling your way out. And he tends to favor that feeling your way out because history and models, well, they're unreliable. Every cycle is a little different. And what do you think about this idea of R star if really we are just feeling our way out? Because to me it sounds like, especially if certain Fed officials think there is a short-term neutral and a long-term neutral, you're talking about a moving target that might not even exist. Is the idea of R star a distraction, or is it helpful? Do you think that the neutral rate is just too abstract and the Fed should say, we're going to go meeting by meeting and we don't know where the destination is going to be?
I think that it's very difficult to say like, oh, we know that there is a specific neutral rate at any point in time. And we saw in the presentations earlier that there's so many factors that affect the actual borrowing costs for the real economy besides the level of short rates today, that it just seems very strange to say like, oh, well, that it's this and not that's the thing that determines. I mean, or alternatively, there's so many inputs that are unobservable that it's not something that's practical. You can't know it, or it's changing every day or whatever. So I think that's sort of the challenge. I think that's sort of where Goolsbee is at as well. I mean, Powell's kind of implied this in his press conferences. We know by its work, right? We know by its works. Like, okay, like you can say like, well, we know where short rates are now. We have a sense of what's priced in for short rates for the next year and a half ish, and then we know what's going on with other financial conditions broadly, and kind of back out from there. But even then, like, what counts as neutral versus not? I mean, Fed officials have for a while been saying their policy, I mean, not so much recently, but like the past couple of years, their policy is restrictive, right? That's the word they use, restrictive. But they kept saying that at a time when you have real growth, not even nominal, real growth of like coming in at 3%, which is at a time when unemployment was already sub 4. That's not what restrictive means. It wasn't even as if growth was decelerating from some even faster rate, which would be consistent with the restrictive. It was just either accelerating or stable at a very fast rate. So it makes me think that the restrictive, whatever model they were using to say it was restrictive, was wrong. Now, does that mean I know where neutral is, or what? I mean, no. I mean, I think the concept of restrictive, neutral, easing, whatever is useful, right? Like you have to have some sense of what it is some relationship between what it is you're doing and what the outcome is. But tying that into R star, I mean, I have a lot of sympathy for the argument the models are weird. I mean, if you look at one of the really popular ones that the New York Fed's John Williams came up with back when he was here in San Francisco, that model has a lot of weird inputs. If you look at they have models, for example, like the output gap or things like that, and it implies some very strange things about what the state of the economy was at various points in time historically. This is one of the points Goolsbee made, by the way. It's like you say a model is different from history, but like the models are all calibrated on historical data, so they're not even like that different from each other, and so you have to make a lot of assumptions about what is going to be holding, that there aren't regime breaks in terms of what sets of data matter and don't matter, and that's why I think you can lead yourself into some weird mistakes. Or people, or related to this, Fed officials would say things like, well, spot Fed funds relative to last year's 12 months change in CPI is unusually high compared to the past 15 years. Therefore, policy is tight. It's like, well, is that really the right way to calibrate it? Right? Interest rates are forward-looking for one thing. People were expecting inflation to slow down, so that's one thing to bear in mind. Also, interest rates minus inflation rates, if you look at a long enough history, there have been a quite wide variety depending on expected growth and all sorts of other things. Like, I don't know, maybe it's not tight, right? I mean, the thing that is interesting, and I don't really know how to square it, is when the Fed started tightening meaningfully, you did see some signs of like classic, Fed tightening. Like bank lending came back a lot, mortgage issuance came down a lot, and yet that did not flow through to things like real business investment, real personal consumption, employment, and so that makes me think that even if some of the channels still work the way they're supposed to, the flow through from those channels to the things that they say they care about have changed for various reasons. I think part of it is household and corporate balance sheets are so much stronger now than they were pre-pandemic that they're just less rate sensitive. I mean, I can't prove that, but it makes sense. But that's like one of the things, the fact that the federal budget deficit is relatively larger and more willing to accommodate things. I mean, like total borrowing is sort of, the flow has been stable even if private sector borrowing has come back. A lot of that's interest, so it's hard to say like how that's flowing through to final demand, but whatever, that's like still, that could be a factor. But either way, it suggests that maybe we think about like a neutral policy stance has changed. And I mean, I think they're kind of coming around to that. Like if you look at where they seem to imply they thought rates would stop falling, it used to be like 2.5, and then it's 3, and now they're like, okay, maybe 4 is fine. So like we're close to that point, right? And then, I mean, we'll see how it plays out. I mean, even before like today's inflation print, but I feel like they were already kind of getting in that view of like we're a lot closer than we thought. And they were very fast in the beginning to start cutting once they started, but now they're like, maybe we don't actually need to do that much more.
One way to look at the Fed's inflation fight this cycle, their aggressive tightening, and then we've eased 100 basis points so far, is they got really lucky. That inflation sorted itself out, the economy came into better balance, and maybe monetary policy had very little to do with it. You saw rate-sensitive sectors maybe showing a bit of a reaction early on in Fed tightening, but then some resilience for a number of reasons. Is it possible that the U.S. economy is just less sensitive to monetary policy than we thought? We kind of use the Fed and central banks as this, steering the ship of the macro economy, and we want to put faith in it as being able to do that, and the Fed is certainly not going to tell people that they can't. But is it just possible that right now, the way that the U.S. global economy are set up, monetary policy isn't the force that it used to be?
I mean, one way of looking at it is this is like the long-term vindication of the people, including Powell and including me, who in 2021 were like, this is going to go away on its own, more or less. I mean, because it mostly did, right? You did have, interest rates went a lot higher. So if you were of the view that inflation was mostly going to go on away on its own and therefore interest rates didn't need to go up, that was clearly wrong. But there was no real economy penalty for the most part to get most of the disinflation we've had. Not all of it, that's a key point difference. I mean, this is something I sort of started thinking about 2.5 years ago. It's like maybe there's some sort of residual change in sort of the underlying rate of inflation from pre-pandemic to now. But it wasn't like, if we think about where inflation was pre-pandemic, CPI was about 2, peaking at, annualized like 10 to 11% in the first half of 2022. Of that acceleration, right, most of that was temporary things related to the pandemic, related to Russia's war in Ukraine. But some of it wasn't, right? Some small bit wasn't. The question was, how much was that? And so the thing that the Fed was reasonably worried about was that if they did nothing, that part would both stick around and potentially get larger over time, in response to what was clearly a temporary one-off or series of one-off shocks. And so that's why they did what they did. And the question is, how much of what they did really made a difference there? And that's where I might disagree with some at the Fed, where I think that another thing that happened at the same time, which maybe they didn't fully internalize because it was hard to judge and you wanted to be cautious, but that the world of 2019 was over because I said things like changes in balance sheets and incomes, and so that you want whatever neutral rate would be, I'm not going to be precise, but it was higher by a couple points. And if that's what happened, then most of what they did in terms of they thought they were tightening is really just moving in line with the change in neutral, which is why you didn't have a downturn, really. There was kind of a slowdown in mid-2022, but that's it. It wasn't a downturn. And it's why that sort of residual bit of inflation has still been remarkably persistent. And something I've been kind of pointing out for a while is, I remember thinking in 2022, first half of 2022, saying, okay, well, a lot of this, what we're seeing with wage increases is very much tied to the fact that there's a huge amount of labor market churn. A lot of businesses shut down, people got laid off, then people needed to do different things because there was a shift in what the economy, what people wanted, what the economy was set up for, and then you have reopenings, so everyone wants to go back, so you have all these shifts going back and forth, and that creates that's a lot of friction, and employers have to pay up to get people to come back, especially if they left and went somewhere else, and so you would think that that's going to lead to sort of a sustained period of unusually fast wage growth, but then it's going to stop because sooner or later everyone will settle down, right? It's like with work from home, there was a big sort of gradual but one-off move of people I'm going to take advantage of work from home, but that's over, right? No one's going to say now, who's been working in an office for the past 4 or 5 years, that now is when they're going to start, moving, somewhere else to do work. Maybe someone, right? But it's not going to be a large proportion. That shock is over. And so the thinking is that churn comes down, and it did come down in the job market, that wage growth would come right back down with it. And what's interesting is that it hasn't. It partly did, but there's been a persistent gap. It's something I've been writing about for a while now. It's an interesting phenomenon. We're still sort of 1 to 1.5 percentage points wage growth faster than pre-pandemic, sort of underlying trend. And so that's been remarkably persistent. And so that suggests to me that unless productivity has grown commensurately, then what that's going to mean sooner or later is that because people have that extra income growth, they're probably going to spend that more or less, and that's been consistent. Spending growth has been pretty in line, and if there's not more output, that's going to lead to faster price growth, somewhat faster, and that's again been consistent, which is that trend inflation has been around 1 point or so annualized percentage point faster than pre-pandemic, give or take. Depends on the measure, but it's pretty consistent across whether it's CPI or PCE or PPI for personal consumption, whatever. All those measures, about 1 to 1.5 percentage points faster than the pre-pandemic trend pattern. Maybe the Fed could have squeezed more to get that last bit out. I personally don't think that would have been a worthwhile trade for them. I don't think it would be good for, like, the benefit of a little bit less inflation versus the fact that we had a strong economy, I don't think is compelling. But I think that's sort of where we're at, and like how thinking about, I don't think it's, luck isn't necessarily the word I would say, but like they hoped going in that mostly would go away by itself. They hoped they could deal with it without a downturn. That mostly worked out. Then this other thing happened, which I'm not sure. I think they're sort of now on board with this, that they would say R star is higher or whatever, but like basically the set of rates, they don't need to cut as much, in other words, to get back to where they are, and I think that's sort of where they're at.
Matt Klein, thanks for being with us today, and thanks to all of you in the audience. We'll see you next time. That was Matt Klein, creator of the Overshoot newsletter and co-author of the book Trade Wars or Class Wars. Ever since last year's elections around the world showed widespread voter disdain for inflation, I've been skeptical there will be support for big fiscal stimulus when the next recession comes. But I think Matt makes a great point that incumbents just tend to do poorly in elections no matter what kind of bad economy there is, and no matter what the policy response was. The other main takeaway I have is that trade deficits are not inherently bad, but the reason for a trade imbalance is very important. As a result, any policy intervention needs to take the cause into account to ensure optimal policy. The Fed's pre-meeting silent period starts at midnight tonight, meaning no public commentary from Fed officials until the March 19th press conference. The Fed is widely expected to leave rates unchanged at this month's meeting, but there's less clarity on how the new Summary of Economic Projections will look. Economic data have been noisy recently, and federal policies are constantly in flux, elevating the uncertainty about underlying economic fundamentals. Regardless, FOMC participants must submit their projections for key macro variables in the year-end Fed funds rate. This meeting might also provide an update on any plans the Fed has for its balance sheet management. Next week's data highlight will be the February CPI, released on Wednesday. The January CPI was ugly, but the Fed's preferred PCE deflator was not nearly as worrisome. Inflation data have given little reason for optimism since last summer, and new federal policies that pose upside risks to inflation have yet to channel into the real economy. Investors will also keep an eye on Thursday's PPI to help refine estimates for the February PCE deflator. With labor market churn near all-time lows, the January jolts next week will give an important update on how job openings, hiring, and quits started this year. The following week, February retail spending will show how consumer spending bounced back, or did not, after falling 0.2% in January. Also that week, investors will look at the University of Michigan's March survey to see how consumer sentiment is faring this month. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.